Good afternoon, and thank you for joining me. My name is Lee Johnson, and I am co-founder of Value Investment Partners. We are a private equity real estate organization located here in Northern Virginia. And if you're ever in the area, let's drop by and let's have a cup of coffee. Today, we're going to be talking to you about understanding real estate cycles and investment strategies. I have a disclaimer here, right? Because on this channel, right, we are just here as investors expressing our personal opinion and not a financial advisor, an attorney, or an accountant. I would suggest that you consult your own professional, financial professional before making any financial decisions. Code of ethics here is we do not accept any money from any sponsor or platform for anything, including postings, reviews, referring investors, affiliate leads, or advertisement. What I want to let you know is that, hey, here on the Value Investment Partners channel, we give you our unvarnished and unbiased opinion on different ways that you could invest in real estate, in particular, multifamily syndications. So here's our agenda for today. What are real estate cycles, right? What can investors learn from real estate cycles? Investment strategies for each phase and some tips that you can use in order to continue to invest. As you may know, just recently, the Federal Reserve have increased the federal funds rate by another 75 basis points. This is now the fifth interest rate hike in this calendar year. Earlier this week, I don't know if it was on Wednesday, might have been Tuesday. I read an article that historically, when the FOMC or Federal Reserve have increased rates by 50 basis points, that would lead to a recession. And this year alone, right, the last three interest rate hikes have been at 75 basis points. That's 2.25% increase in interest rates. And there were two others. And what you have of note is that Jay Powell, the chairman of the Federal Reserve, basically says that they are on a mandate. They are mandated to get interest inflation rates back down to that 2% number. This is what they're driving towards. And I believe it was in August, inflation was at 8.5, which was a little bit lower than what it was in June and July. I believe it peaked in June at 9.1%. So that's why the Fed is doing all of this, right? So let's talk about what is a real estate cycle. There are four real estate cycles, and what we're experiencing right now is probably going to be the recession phase of the cycle. But following the recession phase, and this is a circle, so it can go and start out at anywhere in any point in time. So there's the recession phase. The recession is usually followed by a recovery phase. That recovery phase is followed by an expansion phase. This is where developers, et cetera, get permits and have started building, right? And then they saturate the market, sending it into a hyper supply situation. These are the four cycles of real estate. Now, if you are a savvy real estate investor, what you're going to be able to do is you're going to be able to make investments in each one of the phases. Just like if you are an equity investor, you can make money at any phase of the cycle, whether we're in recession, whether we've had a correction. Those guys know how to make some serious cash. And you can do the exact same thing by investing in real estate. So moving forward, right? Here are the four different cycles, and these are going to be, right, the characteristics that you find in each of the phase. So as I mentioned, we're coming out of a hypersupply situation, right? Increasing vacancies, but this is from a historical context. Depending on where you are, and everyone will tell you that real estate is about location, 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 right? So in the areas where we are investing, Carolinas, Florida, Georgia, Texas, the vacancies are actually decreasing, right? And as you may have known, right, there is a strong demand in these areas where they cannot keep up with the construction. However, with what the feds are doing, it's making it very difficult in order to have a deal pencil out, because the debt that you're having to put on that deal just makes it unworkable. And you still have some owners who are, living yesterday's dream, and they haven't come to the correct mindset that they are willing to accept a lower return at this point in time because the heydays are gone. But inside of a recession phase, you get more increase in vacancies, but all of that supply that was there with the new construction from the hyper supply, that becomes available, right? When you have supply that's available and on the market, right, that's going to lead to increased vacancies, right? And in order to get those assets leased up, usually there's going to have to be concessions and things of that sort. But understanding we're in a totally different market at this point in time. So we're going to just go with what is typical, right? So here you have it. After the recession phase, you move over into the recovery phase, right? Inside of the recovery phase, you have to reach the bottom. The throw is what some people call it, right? Vacancies are going to stop declining, right? But there's not going to be any new construction. Why? Because developers, they can't get projects greenlit in order to be able to move forward. And one of the things about all of these industries when it comes to real estate is that debt and leverage is a primary driver in this particular concern at the same time, right? However, in typical times, you have a recovery phase that is followed by an expansion phase, right? And inside of the expansion phase, one of the things that you notice is declining vacancies. But you will also know that permits are being struck and that there's going to be new construction at the same time. And this cycle repeats itself over and over and over again. One of the things that we want to impress upon you is that there is the financial cycle, but within the financial cycle, there is the real estate cycle that's happening. And while you might have one financial cycle, you could have two or more different real estate cycles that are going through their iterations at the same time, right? So right now, and I believe that we are definitely inside of a recession phase, all right, or we're entering the recession phase. As you guys very well know, the layman's term for a recession is 2 negative quarters of GDP. We've had that already, but there's an official body that declares when there is a recession, and they haven't declared that at this point in time, right? So what do you get at the recovery phase? At the bottom of the trough, right, occupancies are likely at or near their low point, with tepid demand for space and minimal leasing velocity, right? No new construction is underway. However, you might see that the activity for the permits are increasing. Rental rate growth, which is one of the primary drivers that we use here, rental rate growth is either still negative or flat, or later in the phase possibly occurring, but at levels that are below the rate of inflation. And as you guys very well know, I just mentioned that We peaked in June at about 9.1% inflation. And I believe in July and August, it probably was about 8.5% is the rate of inflation. So rental growth is at or near that at the same time, especially in markets in the southeastern region of the United States at this particular point in time. Note, identifying the beginning of the recovery phase is difficult as the market still feels like it is in a recession. But also, just like inside of the equity markets, it's very difficult to time the market, right? And it's going to be equally as difficult to time these different phases. But if you are underwriting deals and those deals seem to make sense to you, right? There's going to be a point in time, and as if you can make the deal pencil, that probably means that you need to pull the trigger just a little bit. Okay, phase two, right? Moving into the expansion phase, things are starting to look a little more healthy, right? The market is on the upswing in terms of growing demand for space. GDP growth is back to normal levels, and quarterly job growth is strong. One of the two things that we're always looking for in any MSA and submarket is that the rents are increasing, right? And the vacancies are low, right? So here, occupancy rates are improving and rents are on the rise. Rents now approach levels that can justify new construction, right? Development activity begins, but before development can begin, you have to have permits, right? Note, there is a high point during the expansion phase, the crust of the wave, where supply and demand is at an equilibrium. But we understand market forces, and it doesn't stay at an equilibrium for a significant amount of time. There has to be some rewards, right, for any investor to move forward into a situation where they're going to put capital at risk. If there is no reward, no one is going to put capital at risk. This is some of the decisions that are being taken forward around the time when you're talking about expansion. All right. Hypersupply, right? Hypersupply, equilibrium between supply and demand in the expansion phase often tips over into excess, right? Oversupply caused by overbuilding or a pullback in demand caused by a shift in the economy. What does that lead? If you have an asset that is not leasing up, you're going to have to introduce concessions such as, a certain amount of dollars off of the rent, right? 1 or 2 months free, or if you can refer someone in, we'll give you some type of concession, etc. But during hypersupply, and these are in normal terms, right? Vacancies are starting to rise, right? Rent growth may be positive, but at declining levels. Otherwise, rent could be growing, it's just not growing at the level that it was growing prior to, right? And as I already mentioned, concessions are prevalent to keep occupancies elevated, free rent for 1 or several months, free access to amenities, which under normal conditions are charged, right? Because how does an apartment complex make its money? By renting out. So any of these concessions that you're having to make leads to a reduction inside of your net operating income, which is always going to be critical here, right? Because net operating income leads to the purchase price for that asset. So it's definitely something that you're definitely going to want to consider. But the phase 4 after hypersupply is usually a recession. And that's caused by a supply overweights demand, right? Which produces higher vacancies, right? Whenever you have vacancies in a multifamily complex, you need to do what you need to do in order to get the vacancies trending in the correct direction, right? You have to make some type of concessions because hey, I would definitely prefer to make a concession when needed to get the property filled up versus having it sit there idle, because we know for sure that when it's idle, right, that property is not making in drawing in revenue, right? So, make a concession or a rent reduction to induce and retain tenants. But one of the things that is critical is that you do not hinder on tenant quality, right? You don't want to just put any and everybody into the asset, right? Especially if the eviction process in your state or county is very lengthy or labor intensive. But the last characteristic that we will have on this slide is that during a recession, because you have vacancies, rent growth during a recession is most likely going to be lower or, well, negative, or at levels that are below the rate of inflation. So you see, when you're looking at multifamily as a whole, you're always looking at the rent growth, but you're also using another metric and tying that to inflation, right? And in certain areas, right, where there is high demand, rent growth is exceeding inflation, and inflation, as I mentioned to you, is averaging about 8.5 at the time of this video. So there's a lot that is there as well, right? But what we talked about is that regardless of the phase, there is an opportunity for you to make a sound investment. It's just that you're going to have to look at different asset classes as you move, right? So when we talked about a recession, right, we were talking about, well, what is a good place that you can move if you can get the deal to be funded, right? But right now, where we are, interest rates are high, but that might be an opportunity where you find something that is going to be opportunistic, where it might cash flow. But one of the things that you always know about opportunistic deals is that they typically have a higher ARR and IRR, and that's what makes those deals work. Opportunistic are going to be assets that don't exist yet. You really have to start from the ground, and that might give you the leeway to make a deal like that happen. When it comes to the recovery phase, you still have opportunistic, but also you have what I particularly like is value add. And why I like value add is because with value add, I already know that the property is a little bit aged, right? However, I'm able to renovate units at turn, right? So when a tenant leaves, rather than immediately getting that pre-leased again, what we're going to do is we're going to have it offline for several weeks while we do the renovation. And then once we finish the renovation, we can turn that property back online and we can increase the rents at the same time. When it comes to core, core is very good at this point in time as well, because that's going to probably be your most attractive asset at that point in time, because core typically has your newer product on the market, right? So it's going to be more desirable than to others. And you typically pick those up from developers and builders, right? Inside of the expansion phase, basically you're looking at every single thing that is there: development, core plus, value add, and opportunistic, right? Things are going good during the expansion phase, and you start really at this point in time, that's when you start to see that everyone is now talking again about investing in real estate, because it's the hot market and the returns that are being received are actually better than in other asset classes, being equities, bonds, or whatever else that you might be into. But then when you move into hyper supply, you have the opportunity to invest again in some core assets and opportunistic at the same time. So, there's always going to be a rule of thumb, right? There is no one metric that you have that can tell you that this is the exact proper time that you should be investing. However, you can use this as somewhat of a gauge per se that's going to help you at that point in time. So all of these will be available on our private Facebook page. So if you haven't joined our private Facebook page, this is your chance to do, and you get access to all of these presentations that we have already presented, right? As well as this one, which has been recently updated at the same time. So when you come to core, right, it's low risk, right? It's offering stable returns, right? You typically might have a longer return period because you don't really have the maintenance that's going to be needed because this is a newer asset, right? But what's going to be particular to you is investors of core real estate investments value stable, reliable, and consistent cash flows over price appreciation. We like value add because we can increase something called forced appreciation is what we like about value add, right? But right now with the economy, with the supply chain and things of that sort, it's a little bit more risky than if you were going with a core or a core plus, right? Properties that are identified as core plus are otherwise core assets, but with some component of risk opportunity attached to it, i.e. high street retail building with tenants that take 10% to 15% of the space, vacating in 2 years, and the space needs to be upgraded and released, right? So there are different places and spaces where you can play. We're just trying to give you a high level overview as you down select into what type of asset class you're going to want to be investing in, right? I'm going to talk here about opportunistic, right? Because with opportunistic, it's a high risk, high return, high degree of uncertainty, more volatility in cash flow, and typical, there's not going to be any, right? Because it's an asset that doesn't yet exist. You're starting out from the dirt, and if it's multifamily, depending on where you are, if it's more in an urban setting, you're going down into the ground and you're going to build up, right? If it's not a multifamily, more suburban, exurb type of incident, yeah, you're going to put those pads out and you're going to start building from there, maybe 2 or 3 story garden style apartments, right? But that's risky because the market at any point in time can turn on you, right? And also, when it comes to opportunistic, there are no cash flows that you can distribute. This is the reason why I'm going to move over here back to value add. To me, value add is medium risk, right? The returns are better than sometimes what you have with your core, right? And your core plus, right? So medium returns, not as high as you get with opportunistic, but you're playing it safe here, right? Typically involves acquiring an underperforming asset with upside potential and added value through one or more repositioning strategies with the goal of boosting net operating income, leading to an increase in valuation and thus increasing the value of the property. This is the reason why I like those. I don't know, maybe it's because I have flipping inside of my blood, but I like value add. Right now, there's a little bit of an additional risk on value add because of the supply chain concerns. It's kind of hard to get refrigerators and things of that sort, which you need in order to be able to lease out your asset. All right, let's move on just a little bit. So there are some tips that we can share, right? So that you have an understanding of how you're going to map, right? Your strategy to the cycle, right? Phases do not necessarily, probably never, right, occur in equal periods, right? Cycles vary depending on geography and asset class. I mentioned this at the top, right? Everything when it comes to real estate is about location, location, location. So you could be having booming times in the Southeast, right? But in the Northeast, where lots of people are leaving, it's not booming so much, right? Cycles vary dependent upon geography and asset class. Also know that the real estate financial cycle is 10 to 18 years in period. So the financial cycle is this longer term thing, and the real estate cycle is happening with inside of the financial cycle or physical cycle, right? Physical cycle affects the rental income, rising, falling prices and vacancy. New construction determines the supply. Demand is driven by occupancy, much shorter than the real estate financial cycle, right? So different things that you have going on. I call this sometimes physical cycle or financial cycle, whereas the real estate cycle is the inside of the financial cycle at the same time. All right. So that's all that we have for you today. And I want to extremely thank you and all of those who were able to join us, right? As always, this QR code is a way that you can always get in touch with us, or you can just, reach out to us via our calendar, right? If you enjoyed this meetup and you want to get information about when we're going to schedule our next meetup, right, you can text meetup to 571-444-8474, right? Our next in-person meetup, so if you're in the Northern Virginia area, we have a networking event that's going to be held on 10/8. That's in person. And our next educational topic is going to be at the end of October on 10/29. I might not have mentioned it, but the networking event is held on 10/8. That's going to be at Ridgetop Coffee and Tea over here in Sterling, Virginia. So I want to open it up to questions. I want to, again, thank you for sharing part of your day with us. We enjoy taking questions. Otherwise, have a great day and happy to work with you all.